Okay, so we in the latter part of last year started a new venture called Waypoint Residential, and the key distinction between Waypoint and Broadway is really just property type. So we have been purchasing office properties around the country for the last 10 years, and as we kind of came through this cycle, thought it was an opportune time to step back and think about what else we might want to do and where there were opportunities in the market. And for a host of reasons, we decided that we thought the apartment sector was extremely compelling over the next few years. And so, having decided on the strategy, we then set about to build a team that would enable us to take advantage of the opportunity. We are really a vertically integrated, very hands-on type of real estate investor, and so we would never set out to make an investment until we thought we had real world-class capability to identify, underwrite, and execute an investment strategy around a piece of property. So over the latter part of '09, we put that team together, and we have a few offices around the country now and are actively involved in the apartment sector, and we think it's a tremendous time to be in the apartment sector.
Why do you think it's a tremendous time? What are some of the drivers in that market?
Well, there's a few things coming together that we think, well, actually, it's past that already. It's already been demonstrated that apartment fundamentals are probably leading the way back, are ahead of office, and so we're happy to say it's not even a matter of calling the bottom anymore. In most markets, there are a couple of markets around the country where this isn't true, but the majority of metro areas around the country, folks will tell you anecdotally and starting to be able to be demonstrated empirically that occupancies have started to come up, rent concessions have started to fade away, actually driving face rate a little bit. And it's a combination of factors, some of which are cyclical and applicable to all property types, and some of which are specific to apartments. As far as what's sort of applicable across the board, of course, new supply has been shut off, so there's basically no new development, and apartments get built much more quickly than other property types, so you can also shut the spigot off more quickly. And so supply has basically been flatlined. And at the same time, though, it seems like we're just about turning the corner on jobs. We had our first real good jobs month last month, I think best in 4 years. And you can very, very clearly correlate job growth to household formation to apartment demand. So all those people who are doubling up with roommates are moving back in with mom and dad.
I got a job, I don't need to,
exactly.
I don't need 2 roommates
I want to
anymore.
get off my parents' couch or what have you. So those two things that are reflective of the cycle have both started to manifest themselves. But over and above that, there are a couple of structural changes occurring in the apartment sector that are also just pretty much empirical data as far as we're concerned. One is demographics, and so the echo boomer generation will peak about as big as the baby boomer generation over the next few years, because it's basically just the baby boomers having kids. So the 18 to 34-year-old cohort will be about as big as the peak year of the baby boomers over the next few years, and they are predominantly renters, of course, because most folks that age aren't buying yet. And then the other has to do with home ownership. As you were pointing out before, when mortgage financing got very aggressive, the United States reached about 70% home ownership. So if there are 100 million households in the U.S., which is approximately the number, 70 million were owners and 30 million were renters. And as mortgage financing has become more conservative and more traditional, as well as folks having lost a lot of their net worth in their homes, that percentage has come back down towards the mid-60s. It's maybe 68 or so now. But every percent it comes down, that's a million households going from owning to renting. So between the cutoff in supply, the job creation we think starting to get some legs, the echo boomer demographic shift, and the home ownership shift, you have 4 major factors, any one of which individually would drive fundamentals in the apartment sector, and we have all 4 occurring at once. So that's what got us very interested in the sector, and as I said, I think we're past the point really where it's a theory and it's more starting to manifest itself. So.
How about the fuel for your strategy, namely financing? What are you seeing on the financing end? Has that gotten better? I'm not going to say it's all better, but has it? Do you see improvement there?
Quite a bit, and also there we have to segment the property types. I'll talk about apartments separately in a minute, but financing for mainstream commercial property types has changed. Nowhere's near where it was in 06, 07 at the peak like we were talking about before, but quite a bit ahead of where it was a year ago. So from
that's good.
You know, from middle of 08 to middle of 09, as a practical matter, there really was no financing for commercial real estate. Life companies, commercial banks, CMBS, all more or less shut down for about that year. And then towards the latter part of last year, each of those started to kind of come back a bit. There's actually a reasonably robust life company market right now. We are in the process of recapitalizing a large property in Midtown Manhattan, and the loan amount will be quite large, several $100 million, and fairly aggressive competition for it.
Good.
As recently as last fall, that it might have been no bid. So that's a meaningful movement. Banks very, very tentatively back a bit. And now the CMBS market has gotten going, and there have been some investment banks originating and actual selling of some bonds. Some deals have gotten done, so that creates confidence for those guys to take some loans on balance sheet and get back in the market. So all that, I would say, is maybe in the third or fourth inning of a comeback relative to peak.
I'm glad the ball's in the air. I mean,
it helps.
Because,
and on the apartment side, it's very different now because we have Fannie Mae and Freddie Mac, which are very aggressive providers of financing to the apartment sector. And so you have all those dynamics I was describing, plus the government agencies. And so the apartment sector is extremely liquid from a financing perspective.
So you mentioned the shortage of supply. Would you think about building new apartments, or are you going to acquire existing?
That's an interesting one. Generally speaking, it's certainly early in the cycle to build. That said, there are certain, for just the right site and just the right metro area, some folks are starting to talk about it again. So it always starts that way, just sort of a slow inching our way back into a development cycle. But broadly speaking, we don't think it's there yet. It's still generally possible to buy for quite a bit a discount to replacement cost. So why build when you can do that? But over time, I think we'll have a look at development, but I don't think we're there on it yet.
Who is best positioned, or why is your company well positioned to take advantage of this opportunity? What makes that a?
Well, there's a couple of things I think that enable you to really capitalize on what we think is coming. One, of course, is access to capital. So to play, you need capital, and that can come in a variety of forms. We have institutional investors, private investors. We've invested in fund format, we've invested in deal-by-deal format, and so on. And we're fortunate to have some pretty good investor relationships that position us to take advantage of things. The other thing has to do with expertise. A lot of the activity over the next few years will have to do with the debt maturities that are coming in commercial real estate, and there really is quite a tidal wave hitting us over the next 3 or 4 years of $1.25 trillion to $1.5 trillion of debt maturity, most of which will not be easily refinanced. So a lot of special situations, if you will, which creates investment opportunity, whether it's buying loans from banks or teaming up with owners to help rework their loans and so on, and becoming partners with them. So whether coming in on the lender side or borrower side, we think that tidal wave of debt maturities creates a tremendous amount of opportunity. The point is, we have a lot of background at Broadway and at Waypoint in distressed debt from various activities over the years and so on. And so we think that beyond just sort of generic, if you will, purchasing of a property, there's a whole other strategic opportunity which we're pretty well positioned to take advantage of. So I think that a willingness to step into some of those situations where you can navigate through a distressed debt capital stack and come out the other end in a good spot is a very meaningful competitive advantage for the next few years.